Well, welcome in again to the Money Wisdom Podcast powered by Johnson Brunetti. My name is Jake Dozer. I am a certified financial planner and advisor here on the team in Connecticut, joined, of course, by my partner in arms here, Nick Colantuno. Nick, would you introduce yourself if you would?
Thank you. Hi, folks. Welcome back. I'm Nick Colantuno. I'm a certified financial planner up here in our Boston, Massachusetts offices. Thank you for joining us on the Money Wisdom Podcast. As always, we're glad you're back.
Absolutely. Of course, we have the questions that we go through really every episode, asking questions from listeners and viewers like you who have written in and said, hey, we want to talk about this. I want to know more about this. And so yet again, we have a question in front of us. This is a question we hear about a lot. We talk about this, I don't know, I probably talk about this literally every day. Nick, I'm sure you do too. My wife is probably bored to death every time I bring these subjects up. She thinks I'm a giant nerd, and maybe that's true. But the question is this: traditional or Roth IRA? You know, when we're comparing these ideas, which one is right for you? That's the question most people want to know. I don't think the answer is either or. I think it's typically both and when, but you know, we can't make the episode 20 seconds long. So Nick, tell me if you would, like, what are the things we need to be thinking about when we're thinking about traditional versus Roth?
I mean, most importantly, Jake, whenever you're addressing the question of which IRA should you be contributing to, it all starts with income. It all comes down to how much money you're making, folks. And the reason for that is because the IRS doesn't want high earning income people running around throwing money into tax-free accounts. So what I'm getting at here is your ability to make an IRA contribution is based on your income. You have to have earned income to put money into these accounts as a contribution. I'm sure we'll talk about conversions and how to get money into these accounts other ways, but we're just talking about new money going in.
Right.
There are certain income limits. So there is no income limit to be able to put money into a traditional IRA. Disclaimer there is an income limit at which that IRA contribution no longer becomes deductible.
No.
But if you are a single tax filer and you're making more than $150,000, or if you are a married couple filing joint taxes making more than about $235,000, you are also not eligible to put money into a Roth IRA. It's all based on the income. You can put money into a traditional IRA so long as you have earned income and you get a deduction for doing it. But if you're earning a lot of income, you can't put money into the Roth IRA. And I think what it really comes down to, Jake, is the ability to make a deduction for those contributions or get the real benefit of the Roth IRA, which is the tax-free growth. I probably jumped ahead in your question. But
that's all right. No, I mean, and I think that there's so many moving pieces with this stuff, traditional versus Roth. I think that maybe let's take a step back. Let's define these. Most folks are going to know the difference, but traditional IRA is the default option, right? An IRA and a 401k, traditional, aka pre-tax, means I get a tax write-off now for the money I put in, and then I pay the taxes later. So it's tax deferred until I withdraw. Conversely, a Roth IRA is I'm paying the taxes up front, or a Roth 401k, paying the taxes up front, and then I'm growing tax-free going forward. So which one's better? Neither are better. Some are better at different times, right? So it's not that neither one is, or the other is a magic solution for anyone, but it's more about how do you relate with them and when do you use them? So Nick described the first way we can relate with them, which is contributions. But as he so aptly pointed out, you can put money in a traditional IRA with any amount of income, but you can't always deduct the money you put in. And that's kind of part of the magic sauce of putting the money in up front and getting a tax deduction. So I want the benefit now. So now you get into these non-deductible traditional IRA contributions, and you can get those into a Roth through what's called the magic of a backdoor Roth IRA, which maybe we'll do an episode on some point because they're super complicated. Or if you really want to get complicated and nerd out with us, we could talk about mega backdoor Roth IRAs, or you can go on Reddit and search them there and be thoroughly more confused than when you searched it in the first place. There's so many moving pieces with these sites. I think measure twice, cut once. I mean, I think number two, the goal, it doesn't matter what we call it. It matters between now and the time you're gone. How did you write the smallest amount of taxes? So you first need to start with a plan of attack of how you're going to use the money. As Nick mentioned, you have to have first an income plan before you have a tax plan, because you can in no way, shape, or form inform your tax-related decisions until you first made decisions on income-related decisions.
Mhm.
And before you start trying to save taxes, make sure you can spend enough from your accounts to pay for your lifestyle. So taxes, in my opinion, should be in the passenger seat, not in the driver's seat. Your driver's seat decision should be the income you need to live your life. And then if we can save taxes on the way, great. If we can't, that doesn't mean your plan has failed. It just means that we don't have to address that yet. So contributions, first way to get money in. Income limits on write-off ability, if you will. Not a term, but I'm coining that today, write-off ability.
I
Accountants
like it.
trademarked. And then here's the other thing. We actually didn't have this in our sort of outline for today, but I also know that sometimes you can contribute both to a 401k and an IRA as far as traditional and Roth. And 401ks have different contribution limits than IRAs do. Is it ever a good time, Nick, for us to be doing both?
Sure. Yeah. And again, it all depends on your cash flow. It all depends on how much money you have coming in and what your life costs, and then how much is left over. It
Right,
then comes down to a decision of where do you position those assets at a point where you don't really, quote, need them today. Now,
right,
if you're not yet eligible to take money out of retirement accounts, which you're not until 59 and a half. So if you're 40 or 50 years old listening to this and you have extra money, but you might want to touch it in 3 or 4 years, don't put it in a retirement account because
right,
you're pigeonholing your liquidity. So it all comes down to cash flow, and really what the objectives of that money is, both in the near term from a tax standpoint and in the long term as far as liquidity and growth potential. So to unpack that a little bit, putting money into a traditional IRA, like you said, the benefit of that is you get deductions. When you're in your high earning income years, when you're in the high tax bracket, when you have the ability to save money for a rainy day, don't pay taxes on that money now. Get the deduction, put the money into an account where it can grow tax deferred. And then in retirement, when you take money out, that's when you pay taxes on it. So again, the Roth works the other way. The money that you're putting into the Roth, you're paying taxes on that contribution now. And a lot of
right,
people like the idea of this because you pay taxes on the money once, it then grows for the rest of your life and you never pay taxes on it again. So again, one of these, one of the questions I always ask people when we meet is like, well, is there anything you would have done differently? And
mm,
more often than not, a lot of people say, oh, I wish, I had put more money into those Roths. And the way I unpack that is them saying today, when we're having this conversation, when they are retired, oh, they wish they probably had their ability to get their hands on money from a tax-free place. So,
right.
that's where it shows the difference between planning for today versus planning for, a scenario or a lifestyle 10 or 15, maybe 20 years from now for some of our clients. So a lot of things to consider.
That's so true. And I think that for most folks, I think that it's not an either or, it's a both. It's I should probably be doing some of both pre-tax and Roth contributions, but at different times. So, as Nick mentioned, maybe I'm 20, I'm at my first job. Maybe it makes sense to do a pre-tax IRA contribution because you're in a low tax bracket. Maybe you're 40 and your career is ramping up and you and your significant other have a lot of income and you're in a high tax bracket and pre-tax contributions make sense. So early career, maybe you're doing Roth until I said that backwards originally. Maybe when you're early in 20 and you're making very little income, maybe you're doing Roth then because, hey, you're in a low tax bracket. Let's get it out of the way. Maybe you're 40 and you're in a high tax bracket and you want to get the write-off, number one, because you're in a high tax bracket. Number two, because you want more take-home pay because you got kids at home and it's expensive, for this stage of life. Maybe you're 60. This is where it gets interesting. When you're 50 to 60, you're in your peak earning years. And so in some frames of reference, I'm in my peak earning years. Let's get a write-off. Let's do pre-tax contributions. But at that point now, here's the other thing that's going against us at this point. Well, if I do pre-tax contributions now, and then I don't need it right away, now it's going to force my RMD, my required minimum distribution, up when I'm later in life. So how do we think about the impact of traditional versus Roth on RMDs And when are RMDs, Nick? Tell us about that.
Yeah, so we'll start there. I mean, the required minimum distribution is effectively Uncle Sam's way of making sure that you eventually pay some taxes on all this money that you've never paid a penny of taxes on before in your life. So the RMD starts for most folks listening at age 73. Again, if you're over 60 or if you were born after 1960, your required minimum distribution does not start until 75. So you've got a couple more years there, a little more wiggle room. But the way it works is you take the total value of all of your retirement accounts. You could have an IRA, you could have a 401k, you could have a 403b from an old employer. Say there's $1 million in those retirement accounts. The rule of thumb, starting at age 73, you have to take right around 4%. It's actually a little lower. It's like 3.77% out of those accounts. So again, that's $37,000, $38,000. Now, if you need that money, right, because Social Security is not covering all your expenses and, you know, all your money's in the retirement account and you were going to take it anyway, well, okay, that might not be such a big deal. But what if you don't need that money, right? This is where a lot of folks they feel forced to take these taxable distributions and pay taxes on income that they didn't really need. So again, planning for the RMD years before you're in them is really critical, because for a lot of our clients, let's say you retire at 65, your RMD doesn't start till 75. Well, that's a 10-year window of opportunity. Whereas you mentioned, Jake, you're out of those high earning income years.
Right.
Maybe now you're in the lowest tax bracket you've ever been in. And if we know that's going to be the case for a decade, well, we can be moving money from those tax deferred traditional IRAs or 401ks over into the Roth IRA. Yes, as I mentioned earlier, you pay taxes when you do it, but you can also be in control of how much you do. And as a result, in control of the taxes that you pay, and in control of the bracket that you fall in, and in control of how that income impacts other things like your Medicare premiums and your capital gains tax rate. And, you know, all this to say there's a lot that goes into it, but more often than not, what we see is once those required minimum distributions start, once you're forced to take that taxable distribution every single year, a lot of times you lose control of being able to manage those taxes. So certainly something that you need to get out in front of, and really something that you need to have a plan in place around. A lot of people look at the money in their Roth IRAs. They like that it grows tax-free. They also really like the fact that if they need to take money out of it, they're not paying taxes on it, and that no one's ever going to force them to take the money out either. So a little more flexibility, a lot more control, and who doesn't want money in a tax-free place? Yeah. It's just, do you have the pain tolerance to pay the taxes in order to get the money there in the first place? Right. I think that's really what it comes down to.
Right. And doing a formal analysis to determine which one mathematically makes the most sense for me. You know, that's so critical. You know, I think you said a word many times that I think is especially poignant in this conversation, which is control. There's plenty of things in our lives that are out of our control. I don't know what curveballs life will throw your way. I don't know what's going to happen. Joel, our managing partner, says a lot of times with the politicians down on Wall Street or healthcare reform. But I do know that you can control whether you have a plan of when to take income, what to invest in, when to pay your taxes. And the sooner you take control of the things that are within your control or that are controllable, the less you worry about the uncontrollable, because you've played the cards that you're dealt. If you'd like further help on these ideas, we'd be happy to send you a kit free of charge that will help you get the ball rolling. We have an Are You Ready to Retire starter kit, and that's really sums up these ideas in one resource. An Are You Ready to Retire starter kit, if you'd like to get your hands on that, we'd be happy to send it to you complimentarily. You text the word KIT, K-I-T, to 800-757-0436. We'll send that out to you, and that'll give you some information to further these ideas. You know, I think when it's all said and done, there's 4 things you need to be thinking about when you're deciding which one's right for you, or when is which one right for you is probably a better question. Number 1, what is your current and your future expected income? Number 2, how old are you and when are you going to retire? Number 3, what is your tax filing status, your tax bracket? Are you married, single, and what's that income level? And number 4, what are your goals? When do you want to use your money? Really, that is how we make these decisions on an informed basis. Let's segue a little bit into some related questions. in our mailbag minute section of this episode. We've been doing this, having a good time with it. This is where we go from a long answer to a shorter answer. I would say short, but neither Nick nor I are great at giving very short answers. It depends. Seems like the message of our life. But let's get into some mailbag minute questions. Question number 1, Nick, I've got for you. Rapid fire, lightning round. First up, what happens to my husband's IRA when he passes? Will it be added to my IRAs?
It can be. And when a spouse passes away, the surviving spouse can roll any accounts that they are direct beneficiaries on into their own retirement accounts. So pretty easy answer there.
Yeah. And there are instances where that doesn't make sense. The other
Sure.
option is an inherited IRA or a lump sum distribution. And I just had a scenario last week where I recommended an inherited IRA so that the spouse could get earlier access because they were pretty young. So not a cut and dry
Interesting.
scenario. Most scenarios it is. It makes sense to move it into a traditional IRA, consolidate. But anywho, I digress. I'm changing this from lightning to thunder. Forgive me. Next question. Prior to my reaching my RMD age, I have been moving money, filling up my 24% tax bracket. Any guidance regarding IRA to Roth IRA conversions?
So we can unpack this a little bit, because if they're taking money out to satisfy the 24%, tax bracket, I mean, one, I would say, why? Is it because they need that money and they only want money to the extent that they don't go to the next highest tax bracket? Or are they anticipating that later on in their life, they'll be in a higher bracket than 24? And as a result, they want to pay the taxes on it now.
Right.
If the latter of those two scenarios is why they're moving the money, converting that money to the Roth would probably make sense, because at least then in the Roth, that money could grow tax-free.
Right.
Get out of the way of required minimum distributions. And in theory, you're paying a lower tax bracket now than you would later. But if they're taking that money out to spend it, well, then putting it in the Roth wouldn't really make sense, because they're just going to be taking it out anyway to supplement their lifestyle.
Right.
So the guidance regarding the IRA to Roth conversions, you're thinking about it the right way as far as posing the question based on the tax bracket. That's the perfect way to approach it. But it really comes down to liquidity needs. When do you need to get your hands on this money? Are you taking it out of the IRAs, paying the taxes on it now because you need to live life with it? Or is there a longer time horizon? If there's a longer time horizon, we would be recommending the Roth conversions.
Also, keep in mind, if you're going to the 24% tax bracket, you got to worry about IRMA penalties, which is Medicare surcharges, which is why 22% is a much more common threshold. But if you've saved a lot, you anticipate taxes going up in the future, or your heirs having a huge taxable burden, the 24% might make sense. Last question, a little bit more general. How can I estimate how long that my money will last, which obviously is a necessary component of this Roth conversion conversation?
Yeah, it certainly is. And at its core, it's a necessary component of really any financial plan. You need to have a very good feel for your income sources, Social Security or pensions or any rental income, or just even interest and dividends off of your accounts. You need to know what's coming in. You also need to know what's going out, and you need to know what the difference is between those two numbers. That will then lead to a cash flow requirement off of your assets. So it's then critical to know, well, what do you have working for you in the background? What is your comfort level with risk? Assuming a certain level of risk off that money, a certain, reasonable growth rate off that money relative to that negative monthly cash flow. You can see where I'm going with this. These are all different pieces to the puzzle that will ultimately allow us to give you an answer on, do you have enough and are you going to be okay? So, of course, it's very hard to answer that question in a minute. It comes down to having a plan. It comes down to knowing your numbers and really knowing, what the road ahead looks like, whether it's a good market, a bad market, whether income or taxes increase or decrease. And again, flexibility and control when it comes to where you're going to get that money from when you need it.
That's right. Well, let me just remind folks that we have that Are You Ready to Retire starter kit available that we'll send to you free of charge. If you'd like that kit, feel free to reach out by texting the word KIT, K-I-T, to 800-757-0436. It's a little bit off script, but if you're that person who says, how can I estimate how long my money will last? And you want help with this stuff, you can call that same number and we'd be happy to set up a complimentary consultation with you where we can see if we can help you and provide clarity around the length life of your money lasting, which is really what we all do all day, every day. Again, that number is 800-757-0436, and you can see that information in the show notes as well. Hopefully you enjoyed and found helpful this episode of the Money Wisdom Podcast. If you did, like this video, give it a share to somebody else who might benefit from it. Subscribe, turn on notifications. Make sure you see this content. We'll continue to post these videos as often as we can, and we'll see you next time on the Money Wisdom Podcast.
Johnson Brunetti is a marketing name for the businesses of JB Capital and JN Financial. Investment advisory services offered through JB Capital LLC. Insurance products offered through JN Financial LLC.